The biggest crypto debate isn't going anywhere. And no matter how many times this topic comes up, one question always remains at the center of it all. What actually gives Bitcoin its value? Because this isn't just another digital asset. Bitcoin sits at the core of the entire crypto space. It's the foundation that everything else is built on. And if that foundation has weaknesses, then the entire structure becomes unstable. Today, we're going to break that down. You've probably heard the same arguments repeated over and over again. Bitcoin is digital gold. It's the future of money. It protects against inflation and broken financial systems. But here's the issue. When you stop focusing on the story and start looking at real data, the picture starts to change. And to understand that, we need to go back to a simple question. What was Bitcoin actually designed to do? When Satoshi Nakamoto introduced Bitcoin in 2008, the idea was clear. It was meant to be a peer-to-peer electronic cash system, a way for people to send money directly to each other without banks or middlemen. In fact, a single transaction can consume as much power as a household uses over several weeks. That's not exactly practical for a global payment system, and that explains why it hasn't been widely adopted for everyday payments. Now let's talk about storing value. At first glance, Bitcoin seems like it could work. It has a limited supply, similar to assets like gold. But there's a major problem: volatility. The price can swing dramatically in short periods of time. And when an asset moves like that, people don't treat it as stable money. They treat it as speculation. That kind of instability makes it difficult for businesses and individuals to rely on it. There's also another issue that doesn't get enough attention: ownership concentration. Even though Bitcoin is often described as decentralized, a large portion of the supply is controlled by a very small percentage of holders. And when that much control is in so few hands, price movements can be influenced more easily than people think. Now, the third function of money, unit of account. This is where things become even clearer. Even businesses that accept Bitcoin don't actually price anything in it. Prices are still set in traditional currencies, and Bitcoin is only used as a temporary payment method during the transaction, which means it's not really being used to measure value at all. At this point, you might hear the common response: it just needs more time. But here's the thing. We've already seen what happens when it's tested in the real world. In 2021, El Salvador made Bitcoin legal tender. It was a full-scale experiment. The government introduced a national wallet, encouraged adoption, and even offered free Bitcoin to citizens. This was supposed to be the moment where everything came together. But it didn't go as expected. Adoption remained low. Most people chose not to use it for everyday transactions. And a large percentage of users only interacted with the system once before leaving it behind. Even today, public sentiment in the country reflects that the system didn't deliver the results people hoped for. So if Bitcoin doesn't work well as a payment method, doesn't reliably store value, and isn't used to measure prices, then what exactly is driving its price? To answer that, we have to look at a concept from finance. It's called the greater fool theory. The idea is simple. An asset's price can rise, not because of its real value, but because people believe someone else will buy it later at a higher price. And when you apply that idea here, things start to make more sense. Bitcoin doesn't generate income like a company. It doesn't produce goods, and its real-world use is still limited. So its price depends heavily on belief. Belief that demand will continue. Belief that new buyers will keep entering the market. And belief that someone else will always be willing to pay more. That's what drives the cycle. Prices go up, attention increases, more people enter, and the process repeats. But the moment that flow slows down, the system faces pressure. And that's the uncomfortable truth behind it. Because at its core, the value isn't coming from what it produces, it's coming from what people expect it to become. And eventually, that expectation meets reality. If you want more real breakdowns like this, hit the subscribe button and stay connected with me.